Welcome to Commercial Real Estate Now in partnership with CBRE Econometric Advisors and my co host, Dan Diebel. I'm Carly Iacono. Dan, lovely to see you. How is everything?
Great to see you, Carly. Things are great. The Pacific Northwest is seeing sun right now after the long dreariness, and the dreariness will come back. This is fall spring, but it feels great.
Take it. Take it where you can
Feeling
get
good.
it.
Yep, taking the wins where we can get them.
It's got to be a very interesting time to be an economist. I know I personally wake up every morning and open my news app and go, what? Every day was something completely new. So I can only imagine if my job was piecing together economic factors, it would be kind of a wild time. How you holding up?
Yeah, great. I like it. It's fast paced right now, which is good because
Yeah.
there's some feeling in commercial real estate that maybe it moves a little bit slow. You know, big deals, lots of coordination. You're not just going and buying and selling a retail mall or something every day.
I wish. I
Uh,
wish. But yes, that's true.
yeah. And there was a lot of like, oh, the economy is doing well. Everything's going well. We're going to see everything's fine, la, la, la,
Right.
for quite a while. And this change up has brought a lot of energy back into the sector,
I
and
love the
forecasts since,
positivity.
yeah, everything.
All
Um,
right, good.
yeah.
Fast paced, living in the fast lane right here, Dan Diebel. All right, good stuff. Well,
Yep.
let's hear about it. Today's episode is all about an economic update. There's a lot of different things we're going to talk about. Just kind of it's time to take stock, right, of all these changes and say, where are we today? This doesn't necessarily mean this is where we're going to be tomorrow, but let's pause for a second and just regroup on some of the key economic factors and give our listeners an overview of what it looks like today. So let's jump in with jobs. We've had so much discussion with Doge and federal contracts and all of that, but what about the private sector? What about the rest of the jobs market? Where are jobs overall right now in terms of unemployment?
Yeah. So that's sitting around 4% when we're looking at unemployment. And that's for the private sector. As you mentioned, the public sector jobs are not included in that.
Okay.
So all of those affected by the recent cuts or layoffs or whatever buyouts, whatever you want to
Yeah.
call them, who
Well,
may have
yeah.
been separated from their jobs at the federal government, that's not going to track any of those. So
Interesting.
when we say the unemployment rate is at 4%, that's just in the private market. The When we look at those government sector jobless claims, they've almost tripled. Uh,
Already.
yeah,
Wow.
and it's starting to reapproach a peak in terms of a level, not in terms of a percent. So still not too much concern there, but it is certainly ticking up and ticking up quickly, and that's going to filter through the economy as well in some potentially troubling ways, especially as government jobs were often viewed as safe.
Stable, safe.
Yeah.
Right. Right.
Hmm.
So back to the private sector for a minute. Where were we last quarter? Is 4% material tick up? Like what does that comparison look like?
It is small decrease in the
Oh, okay.
jobless rate. So yeah, I would not have expected that we would see unemployment at around 4% uh, within the private sector. There's just so much churn and job
Mhm.
finding and everything that goes on. I would have expected the natural rate of unemployment to be a little bit higher. And it does look like maybe around this 4%, somewhere in that 4 to 5% range for unemployment is the natural rate instead of a higher unemployment rate. A lot of that has to do with the short run tax cuts that we experienced, and also the ability to work remotely has brought a lot of people back into the job force and given them opportunities to not have to claim unemployment benefits.
You may not
So
know the answer to this next question, but I'm just thinking about public versus private. And I know the Fed, the mandate that we've heard for years now is 2% inflation and maximum employment, right? Every time Powell
mhm.
does his speech. So when he's saying, do you think maximum employment, is he merging public and private sector? Or is the numbers, the data that the Fed's looking at when they decide monetary policy, is that just one, just the private sector? Do we know? Because this could change that story if we have one side very stable, like you just said, maybe at its natural rate right now, which is great, and then we have the other side going through massive change. So I don't know. Do you think that's going to be a factor?
I think they're definitely going to consider it moving forward. I'm sure that it always played a role in their considerations, but as we've mentioned now a few times, those government jobs were stable. If
Right.
you got a government job, you shouldn't expect to lose it in the past. So that wouldn't have been a consideration in the past. You would see most of the movement in the private sector, not in the public sector. But now we are going to have significant more amounts of movement, which makes me assume I'm not in those meetings. I have no idea what
Right.
they discuss. I listen to all of the like Fed chairs and everything every chance
Same.
I get,
Yeah.
but
Right.
I would assume that as that portion of the economy begins to change more and more, they'll construct a better, more comprehensive way of looking at joblessness other than just in the private sector.
I really hope Powell brings this up on his next speech. I'm going to be waiting
Yeah,
anxiously
we
for him to
we
give
can
commentary
bookmark
on this.
him.
Right.
Yeah.
Wish I could ask a question, but I've not been invited either. But someday, maybe someday.
Yeah.
Okay, let's move on from unemployment and talk about CPI while we're on the Fed, right? The two things that they always bring up. So CPI, I think, is ticked up a little bit this last quarter. Am I correct in that? Where are we right now?
Yeah, it ticked back up to about 3% in January. And the grocery and goods prices are remaining pretty sticky. We do expect to see inflation possibly continue to test upper boundaries as tariffs and other price actions take effect that could increase the price of some of these goods.
Nobody likes to hear that. And it's not
Yeah,
just driven by egg prices, really? There's more there? All right.
yes. I mean, man, egg prices.
I
But
know. $8, crazy. Okay, go on.
yeah, insane. The amount of people that are willing to talk about egg prices now is amazing too. Like never
It's like
before. But like
standard
it's
conversation, right? You could bring it up in an elevator anywhere. Everyone's like, "Oh my gosh," right? Who thought this would be so universally irritating to everybody, but it is.
yeah. And it's
It's
such a
funny.
good example of inflation too.
Right.
It's exactly the same good. It
Yep.
is just way more expensive now. So you're getting exactly what you
Right.
were before. You're just paying so much more for it. And
Right.
explaining inflation to college students who have had very little, especially while I was teaching, where inflation was like 2% for so long, trying to
Right.
tell them that like your money is becoming less valuable every day you just hold it as cash doesn't compute because they don't
Doesn't
have
resonate. Right.
goods that they've experienced that with, like eggs. And now, I mean, I know college
Still
students
now.
probably maybe not be doing eggs, but still, now there's a very real world example that everybody's talking about it with inflation. And
Right.
if those price pressures continue to happen in other sectors, then we could I'm not suggesting that the Fed is going to raise rates, but if inflation does continue to tick back up, then we could be in for, rate hikes, especially if that jobless rate stays low and the private sector can um, take on some of those newly released public workers. Yeah.
I think that's where it gets so complicated, right? These factors don't move in tandem. So you could have increased inflation and increased jobless claims or unemployment. And then is that stagflation? I'm going back to college.
Stagflation. Yeah.
Stagflation. I remember studying that in economics. Okay. So you could have, and I remember being very undesirable, very hard to get rid of stagflation. Um, and that's the challenge, right? One metric might be great, another might be falling off a cliff, and then how do you balance those? So that's why all these different data points matter, because it's a full picture, not just one in isolation.
Yeah, abs- absolutely. And I think I see where you're going with this in terms
Yeah,
of
but it's, yep, go for it.
stagflation. Great. So stagflation is negative growth or negative GDP growth
Yep,
with elevated inflation.
right.
And one of the
And
reasons why that is so harmful is that you're spending more and more out of your pocket. You're getting the same, but your future is becoming more and more difficult because it's getting more expensive and your prospects are not there, right? If you're jobless, you have even less ability to support yourself while you're trying to find your next
right.
job. And with the Atlanta Fed recently releasing their GDP Now forecast of negative 2.8% real GDP growth. So that's already accounting for inflation. They are saying we are going to have negative real growth.
I think that's crazy. Like that, not that their prediction is crazy, but it's to me
Mhm.
quite shocking, right? Because we've been humming along like, oh, the economy's doing great. We have strong GDP numbers. And then you have someone like the Atlanta Fed, this isn't like a small time shop, right? Coming out and saying, no, no, it's actually going to be negative. What was it, 2.6%, 2.3%?
2.8.
Um,
Yeah.
okay, 2.8. That was close. So you're going to have negative 2.8 growth. That feels like such a dramatic shift to me. Are other economists in line with these predictions, and how real, or how, I guess, how much do we trust that number?
Yeah. I will say the Atlanta Fed GDP Now forecasts are nowcasts are pretty good. They've done a
Okay.
pretty good job. Um, with that said, they move around a lot
Okay.
right up until those numbers are finalized. So, like, it has forecast 3 or 4% real GDP growth in the past, and nobody lost their minds there. Whereas, like, 4% real GDP growth, that is a huge increase in output in your economy over a year.
But it's
Um,
positive, right? So no one lost their mind because it's to the positive. So we all love that. It can be as good as you can make it. But when it's to the negative, I think that's when you go, oh, wait, hold on. This is pretty dramatic.
yeah. And oh boy, we to kind of understand the negativeness and why I'm not that concerned about it, uh, we do have to kind of look at the math of the equation. So remember, GDP is just all of the final goods and services produced and sold uh, by the United States over that time period. So it's only for final goods and services. So like any secondhand stores, anything like that, that certainly contribute to our economy, uh, but are not new goods and services, those won't be counted in GDP. So
Okay.
when we have negative GDP, it just means we're making less new goods and services than we did before. Uh, or sorry, we're making and consuming less uh, goods and services than we did before. So there are 5 parts to GDP, and we put international trade into one. We mush those together. There's consumption, investment, government spending, and then net exports.
So two of those are in the news, I feel like every day, right? Government spending and I would assume tariffs, affecting trade. So do you think that this prediction from the Atlanta Fed then is predicated on those two more than the other factors, perhaps being to the negative?
Yeah,
Okay.
absolutely. And they noted this in their release that it is mainly driven by the trade balance changing, in that we believe we're going to be exporting more, which is bad news if you want to travel abroad because it means that we'll probably have a slightly weaker dollar moving forward. But other good things could come of that, which would bring possibly more jobs to the U.S. if we start to export more and import less.
Okay.
Um, Fortunately, one of the weird things about GDP, and like this was a trick question that we used to have to ask all the time uh, while we were teaching, and that is what happens to GDP as we increase our imports?
We
And
already
the
told me it's a
answer,
trick question. So yeah, it's
yeah,
gonna be opposite. Go ahead.
right. So typically, if we import something, that would go out of our GDP, right?
Right. We didn't make it. The
We didn't
dollars are
make,
being spent elsewhere, not in the US goods.
yeah,
Yep.
but it sneaks back in through consumption.
Okay.
So actually, everything we import is a net zero in terms of GDP when we're talking final goods and services because we consume it. So it gets counted as a plus and a minus.
Okay.
So that balance between exports and imports here is we're actually saying we're going to be exporting less. So the difference between exports and imports is actually going to grow and our trade imbalance is going to get worse, not better. Um, yeah. And that's
And
because sorry, go ahead.
that then would affect GDP because it wouldn't be a net zero, right? Like you just illustrated.
Right.
Okay.
So we essentially countries won't be able to buy as much of our goods because we do currently have a fairly strong dollar and it will take time to devalue the dollar to make our goods more affordable for other countries to purchase. Um, and that's going to make it harder for them to import our goods. So we have less exports to other countries. That brings that down. In the meantime, we're still importing the other goods. We're just paying these higher prices. We don't
Mm,
have factories set up to consume the goods that we import because we import them.
right.
So, yeah, in the short run, imports is going to stay fairly stable. It may even need to increase as, um, retailers fear further trade retaliation. They're building up their inventories, so that's
Right.
going to pull up uh, imports as well. So, that balance is getting changed, and that's the main reason for the negative GDP, combined, of course, with less government spending.
I would think that would even out, not the government spending part, that's still a wild card, but I would think the retailers stockpiling inventories would kind of work through the numbers within the next few months because that can't go on
Yeah,
indefinitely, right?
yeah,
So we might
exactly.
have a quarter or two of really wonky numbers up, down, around, and then see a little more clarity or stability second half of the year. Is that how you're looking at it? Maybe.
Sure. I hesitate to say clarity.
Okay.
Um,
And stability probably is the wrong word right now. And
yeah, I mean,
I take it
yeah,
back.
the the policies are not necessarily clear. Like
Right.
it's unclear how policies are going to be enacted and what policies are a priority sometimes. So clarity into the future is difficult. But I actually do think overall the economy is more stable than some of these numbers would have you believe, like you mentioned. They're going to
Yeah.
bounce around a little bit. There's a lot of change happening right now. So
Right.
those numbers are going to change a lot. And then we're going to kind of hit a new, what we like to call steady state. And then things will hopefully settle down a little bit in the second half of 2025.
So, what is all of this instability, all these different factors doing to consumer confidence? Where are the numbers? I guess our last reading would have been last quarter. Where are the numbers now?
Yeah, so they did just publish February's numbers. So
Okay.
I did this monthly, not quarterly. So these are
Oh,
monthly, but I do have month to month and year over year.
okay.
Consumer confidence went down almost 10% month to month.
That seems tremendous month to month. That is a big, I mean, in 1 month, that feels like a huge shift. Is that normal? Is that just an outsized change?
So it is abnormal, but previously we were dealing with a higher base of confidence.
Hmm.
Uh, Consumer confidence kind of reached a new low post-pandemic, I obviously. And then it has started to tick back up, but it has never made it back up to kind of its initial values. So
Hmm.
now that it's already lower, we do expect larger percentage changes moving forward,
That makes
regardless of
sense.
all of that.
Yeah.
10% is a lot of confidence to lose. That's a full letter grade if we go back to, you know, elementary school, high school,
Nobody
whatever.
likes that.
Uh, yeah, so that's a lot. And the fact that it's down 10% month to month, but 16% year over year means like
Right.
these January to February was not a fun time for consumers,
Right.
and they they don't like inflation. That was made very clear. And with those tariffs looming, that's going to raise prices at least in the short run. There are some people out there espousing that it's not, that it will be transitory, but I think it's going to be further reaching than they realize, with some of the knock-on effects and retaliatory tariffs that weren't really, um, that I would argue the administration was not prepared for, given that they asked for a report on
Right.
retaliatory tariffs after they'd already instituted tariffs. So, I think there's a lot more to go here in terms of those negotiations around tariffs.
For sure. What is the time frame for transitory versus sticky, or whatever the inverse of transitory is, inflation? Is that 2 months? Is it 6 months? Do we have an actual bracket on what transitory means?
Um, no.
Come on, professor. No?
So this is oh my god, this is one of the most frustrating things about economics. The short run is when variables, whatever you're looking at, are not in equilibrium. So it means they're moving back towards equilibrium. And the long run is when variables are in equilibrium. Uh, so
Very clear.
saying something is transitory is just saying that it will be a short run effect, and we don't expect the long
Permanent
run.
change.
Yeah.
Okay.
So for instance, unemployment is 4%. I would think the natural rate of unemployment is higher than that.
Mhm.
So this lower level of unemployment is transitory, as we'll move back to what I think the natural level of unemployment is, which is somewhere above 4. Um, so having said that, nope, there's no window. The short
Okay.
run could be infinity, the long run could be infinity. Typically, we do see any sort of mathematical model or anything like that. Within about 5 years, it will go back to kind of a steady state or a stable period of equilibrium, depending on what model you're using. But most of them within 5 years or so do give you a sense of equilibrium in the models and otherwise, so you can kind of see these run versus cyclical short run effects.
Mhm. So I'm going to say transitory is anything from a week to 5 years, and equilibrium is 5 years on. I'm just, officially setting that now because I think it's time we had a parameter for economics. So you're
I'll let
welcome.
the AEA know that
Please. Thank you. Thank you.
you've
You're
set it
welcome.
down. Absolutely.
So we did a full episode on consumer debt, but I think with all these economic factors that we just talked about in flux and all these updates we just gave, it would be prudent to touch on that again. How have consumer debt levels changed recently, and are we worried about this shift?
Yeah, so we did that episode, and then the new data came out like a month or so later, and one of the things we discussed in that episode was that we would likely see delinquencies tick up because consumers were spending more than they were making. And we did see delinquencies, especially in credit cards, right? Because that's your short-term financing.
Mhm.
Uh, in credit cards did tick up to just above 11%. So 11% of credit card balances, that are observed are 90 plus days delinquent. And that is approaching historic highs.
That feels very high as a percentage to me. And when did we last see numbers like this? You said it's approaching historic highs. Was there another pivotal point in history? I'm guessing it was the GFC, but is that correct? When did we
Yeah.
last see credit card debt like this?
Yeah. Coming out of the GFC. And what helped bring it down coming out of the GFC was that interest rates were getting cut because they were trying to
Right,
stimulate the economy.
right.
And most credit cards have a floating rate. I know that credit cards are a dime a dozen. Please don't tell me that your credit card doesn't have a floating rate. Um,
Right.
uh, most of them do have a floating rate. They're tied to some sort of interest rate index. So as interest rates go down, typically you don't have to service as much debt, and that helps you recover in other sectors. So one of the nice things is that even though credit card delinquencies are really high, student loan delinquencies are very low.
Hmm,
Now,
interesting.
yeah, some of that is just the reporting and the pause from the pandemic when payments were paused, interest was paused. It helped consumers catch up. And I would expect that delinquency to continue to tick up. And it may have some sharp rises in the short run, as we've just discussed. There are going to be changes. Um, but if that gets too high, then that's where I will see if credit cards continue to tick up, that's concerning. But
Right.
if those student loans begin to tick up, that's going to be more concerning to me, especially because there are a lot of ways to service your debt and not go delinquent and not be tagged as delinquent on a student loan very flexibly at a very low, like meeting your minimum payment.
Hmm.
But if that starts to tick up, that's going to erode the wealth of your higher earners, which is going to have an outsized effect on consumption.
So I read a stat that said about just shy of 11%, I think it was like 10.75% of credit card users who carry a balance pay only the minimum due every month as of Q3. I think that was CNBC. So that's not even in the delinquency numbers. That just means people are paying the minimum, which could be like, $25, very low balance each month. So the debt levels, I know we don't have the stat in front of us, but I would assume that overall debt level is increasing, you know, at a higher percent, at a faster rate as well. Do you think that would be a safe assumption?
The overall debt level is increasing. Credit card debts ticked up. Yeah, it looks like all of the debt types
Or
ticked
higher?
up with the exception of student loans, which means total debt
Okay,
is growing uh, more, or sorry, total debt is growing more quickly than delinquencies. Yes. Um,
interesting. So
yeah.
that could be a precursor down the road of further delinquencies if we see more and more people limiting their payments to the minimum due. I don't think you
Hmm.
can do that forever before you reach your outside you know, lending power.
Yeah.
So, one more thing to watch, right?
Yeah.
O overall, um, I think the economy's still healthy. Give us a ray of sunshine or not, but give us your overall 10,000-foot view of how all these factors kinda play together and how you're feeling over the next quarter.
Yeah. Lots of change happening right now, which is always concerning because change is hard. It's hard to go through change. It's easy to do the same exact thing every day. But when these changes happen, especially when they come from, a national level and it has to go all the way down to federal, state, local, uh, that's change all along the way at every rung. And that's a lot. That's a lot of burden to take on from workers and consumers. And I do worry that some of their depleted confidence is going to manifest in spending. But as you said, overall, I'm not super worried yet. Like, we're ticking back up towards these historic levels, but I think there are still some release valves that can be exercised. We actually have a elevated interest rate right now, which is really good when you need to put some inspiration back into the economy and lower those rates. Previously, when we were in the liquidity trap, we didn't have that little tool. So like the tools available to stimulate an economy that shows weakening signs, I think we have them. Just as long as we don't make some sort of policy error that puts us in a situation we can't claw back from.
And I do think not to get political, but I think the current administration did say to expect pain in the short term, right? But not long term, that all of these goals were necessary to create growth and stability in the economy. Of course, that's the political side of it. But I think
Right.
pain in the short term is not unexpected, but that does not necessarily mean everything is dire, right? I think that was
Yeah.
my takeaway.
Yeah. And yes, there will be pain in the short run.
Right.
Yeah.
But hopefully, sunshine and rainbows in the long run.
Yeah, that's
That's
how
what
we
we're
grow,
hoping.
right?
Yeah.
Yeah.
Change is how we grow. Exactly.
Mhm.
As an economy, as a nation, as people on all levels. So, well, this has been great, Dan. Thank you for giving us an update. I think these check ins on all these different economic factors are more important than ever. That it's really crucial to stay informed, stay educated as our clients are making investment decisions. So, thank you very much for being our resource and helping us put all these pieces together to get a bigger picture and a bigger look at the economy. Much appreciated.
Yeah. Thank you so much. And thank you so much for having me. It's always fun.
To everyone listening, that was this episode of Commercial Real Estate Now with CBRE Econometric Advisors. We're so happy you tuned in, and we look forward to seeing you again very soon. Have a great day, everyone.